10-year bond yield, this is another thing while I was gone. Higher lows, still lower highs. So again, that's the other big risk range to pay attention to this morning is the 10-year. So now the 10-year yield being the risk range, super important. Again, 2.74% is the low end of the range. It's percent. And the top end of the range is 2.86%. Okay? So we got pretty close to this number on a higher inflation number last week. And there's no reason on a lower GDP number than what the crowd expects that you can go back to 274. So there's going to be this tit for tat. We're going to get higher inflation numbers, and we're going to get lower headline GDP number. So again, again, opposing thoughts in your head. It's like, well, maybe you should drink Red Stripe this morning. I mean, this is really the point. It's hard to do this. It's not easy. It's not going to give you an opportunity, this market won't, where everything forever did what it did for us for 15 months. Everything was buy the damn dip. Everything was very obvious. Growth was accelerating for 7 consecutive quarters. By the way, that's never happened before. Actually, I shouldn't say never. It's never gotten above that before. If you look in our current macro themes deck, Josephine, if you take a rip over to slide 21. I thought I'd be a little off my game this morning. I can remember the slides. Look at that. Okay, you are here. This is how many quarters of accelerating U.S. growth you've had. 7. That's going back to 1948. Again, this has only happened one other time before in the 1990s. So unless it's different this time, there's still a pretty good chance that we get a deceleration from the cycle peak in U.S. growth. And that's the real concern that I have, okay? It's not that we know what we already know. You already know that Netflix had a good quarter now. That's yesterday's news. In fact, we actually think they'll have a good quarter next quarter too because they have easier comparisons and their business is good. But Netflix is not the U.S. economy. So again, we're in a very dangerous spot. Next slide actually too, slide 22, Josephine, can show you, we take that same data point, which is the consecutiveness of it all, the rally in growth, awesome, just fantastic, and we did nail it. Pat on the back. To Darius, actually. But
the whole team.
And then you got bottom right corner is what? You've never seen that dot before because we're showing the growth versus volatility. Volatility's never gone that low before during, first of all, it's never gone that low before. And you've only one other time seen that consecutive run in growth. So you are here. You're in the land of complacency. This is precisely why I think, again, go back to where are my doodles? Can I go back there? This is why I would submit, because I'm allowed to submit whatever I want, that this is there. This is complacency or capitulation. My inbox, I can assure you, institutional guys that are more in the flow with me every day, all of them asking me about this NASDAQ breakout signal. It's not a breakout signal. It just got above the trend for a day. Like, relax, okay? And I know people don't want to be spoke to that way, so I have to be a little bit more reasonable. But the reality is that it's like a day. And it's incongruent with the rest of everything else I went through in macro. Okay, so what we have here is an inability to communicate to the people who have to always be in the business of be bullish. Okay, we've always had that inability. What we also have is an ability to communicate to people who are allowed to go both ways that this is a very complacent setup within a very dangerous, broader, longer-term picture.